Hello and welcome back. It is time for our next session. Good morning and welcome to the Singapore Property Show 2021. For those of you who are joining us, it's brought to you by MediaCorp and our partners 99 Group and also all the top real estate agencies in Singapore. We're talking about Propnex, ERA, Huttons, Orange Tea and SRI. My name is Stephen Chia. I'll be your host for the morning. Now, in our first session here in Hall B, we're going to have Ismail Ghaffar, the CEO of Propnex, and Ms. Wong Siew-Ying. She's the head of research and content at Propnex. They're going to share with us a bit more of the market outlook for 2021. I mean, a lot of us have been curious about how the pandemic has affected property prices. Well, this is a chance for you to have some of those questions answered. I mean, private home prices have been rising by 2.9% in the first quarter of 2021, and I thought, that's crazy. I was asking Ismail, I was like, why are prices going up? I thought this pandemic, shouldn't prices be going down? Well, he will have some answers for all of you at home. Just before I hand the time over to them, a reminder, there will be a lucky draw. 2 of you stand to win $100 cash prize, so make sure you take part in that link. I'll be back at the end of the session to reveal who the winners are. Otherwise, this special hot seat is now reserved for Ismail, who is standing by. Come on in, man. The time is all yours.
Thank you so much. Thank you so much, Steve. Now, hi everyone. I think this has been the show that we have been waiting for, and it has been in the making for a couple of months. And today I'm so happy to be starting the first event together with Wong Siew-Ying. She's my head of research and content. Many of you would have missed her voice, especially she has been with MediaCorp for way back. Hi, Siew-Ying, how are you feeling out there?
Hello, hi Ismail. Good morning. Good morning, everyone.
Hi, good. Yeah, so what we are going to do here is this. In the next, maybe you can make the shots a bit tighter, is also all right. Yeah, thank you so much. And I tell you, it is really so happening at the right studio here, Siew-Ying, and for the rest of those people who are out there having fun. And I must say that in the next 40 minutes or so, Siew-Ying and myself, we have lined up a couple of slides, and really we have curated some of the statistics to really give you a good flavor of the pulse of the Singapore residential market. So with that, Siew-Ying, maybe you can lead us through the first few slides.
Yes, actually we do have quite a few bits of information data to go through. So we'll very quickly cycle through the slides here. Just bear with me. Well, a quick summary, I think leading on from what Steve has mentioned earlier before going into this segment. Yes, last year the property market actually did unexpectedly well given the circumstances, of the pandemic as well as the economic downturn. So we saw demand for homes actually ramping up through the second half of the year, and also into the first quarter this year. So we'll go through some of these numbers later. Essentially, a lot of the catalysts actually that drove housing demand last year, they were also at play earlier in the first quarter. So we're looking at, the story of a gradual economic recovery, Singapore being a safe haven for investments, and also pandemic measures as well as the ongoing vaccination drive. Not forgetting the low interest rate environment that actually helped to sort of bolster consumers' buying power. Very quickly, I think what we hope to address today, some key topics I think people have been wondering as well. Why the market has been so resilient. Prices are still rising. I think, whether this is a good time to enter the property market. A lot of people want to know this, as well as whether, you should go for resale or the new launches, because the new launches are quite attractive as well. And 2 other points, they are more of what ifs, so what if there are new measures, further down the road? And also with the tighter pandemic management measures, how will they affect the market? So let's quickly jump into it, Ismail.
Yeah, Siew-Ying, looks like we have gotten a huge number of topics that we want to achieve in the next 45 minutes or so. I think the million-dollar questions a lot of people are asking: should they wait? Should they hold on? Will there be a cooling measures? Will prices come down? And these are all the huge number of concerns and questions. Probably if we can finish a bit faster, then we will have a couple of minutes to answer some of your burning questions. But looking at these slides, I think the private new home sales and robust demand. What I look at it here is this, Siew-Ying, if you look at it, the demand for the last couple of years, especially when I look at it the last 2 years, 9,912 units. And again, we had another 9,982 units for last year. But interestingly, when we look at the average over the last 10 years and the last 20 years, it has been about more than 10,000 units. And what is interesting here is this, for the first 4 months, what is the number showing? For the first 4 months, the new launches have already taken place.
So if you take the Q1 and April's figures together, we are looking at about 4,750 plus units, which, it's just shy of half of last year's numbers, Ismail. Do you think this demand is actually sustainable given the circumstances now?
But I honestly don't think it is sustainable at that level, because when we look at just the first quarter, which is 3,000, almost close to 500, and you multiply by 4 quarters, it is going to give you a staggering number of 14,000. And that is going to be almost back to year 2013 before the total debt servicing ratios were introduced. I don't think it's sustainable, but definitely we are going to surpass last year's numbers. Why don't we look at other slides and then we can give them more understanding.
So actually, looking at this slide, I pulled this out. These are some of the projects that did very well in 2020. Interestingly, quite a number of OCR projects. And, given that last year, because of the circuit breaker, there weren't that many launches, and, buyers have had to dip into previously launched projects. Ismail, looking at this table here, what stood out for you?
I mean, one of the key things when I look at it is, look at Treasure at Tampines was March 2019, Park Clementes was August 2019, and Jadescape was 2018. In fact, these developments were not even launched last year, and yet they were the top 3 best-selling projects. So what it does really means here is this. Today, buyers are not only looking at the weekend of the new launches, but they are also looking at developments that have already been launched in prior years. So what's important is sensitive pricing. And then when we look at the average transacted prices for the top 3, they were all well below the 1,800 mark. Obviously, a strong demand from HDB upgraders, I assume.
Interestingly, so the next slide actually will show some contrast. We pulled out some top sales projects in the first 4 months of the year. Interestingly, we see a lot more central region projects, RCR and CCR, just because there've been more such projects put on the market. If you look at the top few, Normanton Park, Midtown Modern, the Reef at Kingsdock, they were all Irwell Hill Residences as well. They were all launched this year. And it's interesting that it seems that people are more willing to pay for central region home, Ismail.
Yeah, I think this is something quite apparent from the earlier slide that we saw for the whole of last year and just for the first 4 months. In fact, the top 4 all come from the rest of the central region as well as the core central region. Normanton Park stood out very well, selling 800 over units, though it was just launched in January. One of the key things that we notice here is this: because developers are pricing it attractively, a lot more people and Singaporeans are ready to enter the CCR and RCR.
And also looking at the next project, next slide, I mean, we crunched the numbers of some of the mega projects with over 1,000 units sold. And, interestingly, a lot of the projects have sold fairly well. If you think back 2-3 years, I think there was some concerns about, potential supply glut. So it appears that, that concern has been allayed so far, Ismail. It's not such a big issue, right? And, why are these projects enjoying such good take-up with, steady sales throughout the last few quarters?
Yeah, I think one of the key things here is you are very right, Shuing, because a couple of years back, it was not common to hear mega projects above 1,000 units, 1,005, or for that matter, even 2,000. People always wonder, will such development will have a complete take-up rate, especially when a developer, regardless of the size, still have got 5 years to sell the last unit. And therefore, people did predict that some of these developers will be very stressed as the 5-year time frame is up and they are likely to slash the prices. But looking at this, we have tracked down almost literally every development have sold well above 60, 70, 80, even 99% for Park Esta, a development of almost 1,400 units. So what it means here is today people are looking at mega projects in an open arm for 2 reasons, Shuing. Number 1, the mega projects do give huge amount of facilities and lifestyle. Number two, the developers are able to enjoy economies of scale because of the mega size in terms of construction costs and all other things, and it is being passed on to the buyers at the attractive pricing. So which means to say there is not likely to have a glut in supply as more of these mega projects are being absorbed.
Ismail, and also being such a big project, they have a wider selection of units for buyers as well, right?
Used to be. You see, that was one of the good things if you talk about in 2019 and 2020, exactly, even though Treasure at Tampines stood out as the #1 selling projects. But right now, with the dwindling stocks of most of these mega projects, people have got slightly lesser choices, as especially the smaller and more affordable units are being picked up.
You mentioned dwindling units. Actually, in the OCR, if you look at the first quarter, we actually haven't seen that many units being launched. If you look at this chart, OCR in the first quarter, 570 units being put out. And if you compare that with RCR, that's not even a quarter of that, right? So going forward, what does this limited supply in OCR mean for buyers? What would you advise buyers if they want to look at OCR units?
I mean, I reckon, Swing, from these data, it is quite apparent. I think we got some other slides in terms of the overall, the existing supply, demand, and the balance, and how many years it can last. But having said that, especially for people who are looking at property in the OCR, they have got lesser choices in the absence of more new launch being in the pipeline. So I think prices are going to be resilient because we know the price mechanism is a works of demand and supply working at its best.
So looking at the new sales, earlier we saw a number of 4,755 as a whole. So if we break it down by region, interestingly, if you look at CCR, that's in yellow. In the first 4 months of this year, it's already crossed 1,100 units sold, new units, compared to 1,260 last year. So this year we're looking at CCR potentially crossing that 2020 mark. And if you look at the last few years on this chart, actually 2020 CCR sales has been the strongest since 2015. Ismail, looking at this, you think the local demand for CCR homes are growing? Do you expect this to continue?
I think true, Swing. I think as we already highlighted in the earlier part of the thing is, when I look at it from 2015, 16, 17, 18, 19, the entire year numbers are much lower than the 4 months of the cost central regions. I think there are a couple of things that is at play, I must say. We must also understand that in year 2017-18, there were a huge number of en bloc that were starting to be rolled out last year and this year in the market in the cost central region, coupled with some of the very exciting government land sales. I think we look at it as the best performing Midtown and as well as Irwell have contributed huge numbers. So I will not be surprised for this year, the CCR is going to well exceed the 2,000 mark. But thanks to attractive pricing, Singaporeans who in the past tend to always avoid looking at cost central regions are now open to purchasing the cost central regions properties. But what is worrying though here is this, when we look at it here, Swing here is this, as we earlier mentioned about the OCR properties, for the first 4 months, if only 1,325 units. So there is a lack of supply, I must say, in the outlying areas.
And, interestingly for CCR as well, you mentioned Singaporeans. In 2020, actually, CCR new launches, 79% of the buyers actually were Singaporeans. So actually, there's good, healthy demand from locals for CCR projects. We'll come to the OCR shortly. I think the next slide we'll pull out has to do with the resale market. Ismail, very strong resale demand as well. First 4 months, 6,000 units. Looking likely that we may see eventual resale volume touching or even crossing 2020. What's your take on overall resale this year? Do you expect, to see a rebound back to the 13,000 or 14,000 unit sort of level?
I am quite confident, Swing, when you look at it, look at from 2013 to 2016, ever since the total debt servicing ratios were all introduced, the numbers were 6,000 to 7,900 at maximum. And we are talking about 6,000 units of the resale flats being sold in just the 4 months. So we are absolutely sure the resale market is going to outperform the last almost 7 to 8 years, and it is likely on the cards of hitting the 13 to 14,000. And I probably we can share in the next slide based on the price gap. What is driving the demand for resale market, and what should people look out for when buying a resale market? And that's something we will share a little bit more in depth, Swing.
That's right. Actually, the next slide, just want to point out that, the 6,000 plus resale units sold in the first 4 months, the OCR again coming out very strong, 3,120 units sold in the resale market were actually from the OCR segment. Essentially, I suppose two big story here. HDB upgraders coming in, as well as the fact that, as we saw earlier, there hasn't really been that many, fresh launches in the OCR, in the last few months, right? So people are dipping into the resale market for OCR units. What's your take on this, Ismail?
I think this is quite evident, simply because, how do we look at these color bars here? It represents different years, blue being year 2019, orange being 2020, and for the first 4 months, 3,120 units in the resale market. So as we realize that in the lack of newer launches in the OCR, people are looking at the resale market and actually driving the numbers. I think that, in fact, when we look at it in terms of CCR 1,206 and RCR 1,700, in fact, the numbers of OCR combined the both is still much more than 50%, looking at the overall numbers. So I think this trend will continue, but hopefully we are able to give some better understanding what people need to look out for when buying the resale flats in the subsequent slides.
That's right. Looking at the resale market itself, I think we've seen demand really ramping up. So what's been driving it? Ismail, as you mentioned earlier, price gap is one factor, and we will look at this point later on. Also potential, construction and completion delays because of the manpower crunch right now due to some of the travel restrictions, right? And I think also we're looking at limited launches in the new launch market. We've talked about this, as well as the HDB market's been doing very well. So we'll explore some of these points shortly. Ismail, this is the slide that you were referring to earlier. So it is true that on a per square foot basis, we do see a fairly sizable gap between the new sale and the resale homes. But interestingly, actually, all segments tracked here, new sale non-landed, resale non-landed, and also even EC new sale. The price trend has been positive since 2011, and we're looking at average prices here. Yep. Ismail, what's your take on this?
I think I want to spend a little bit more time in this particular slide, Swing, because to all the listeners, thank you so much for logging into the SPS21 together with Wong Swing and myself. We try to make it as much crisp in our explanations because so that with the aid of the slide, we hope that you can have a better understanding the movements of the market. But looking at this, a couple of things that stood out for me in the last 10 years study that compiled by Swing here is this. At the average price, when we look at, let's say, a resale property, which was at $1,082, it has moved to, in the first quarter, to almost $1,300 over dollars. Yep, in terms of the prices. So what this means here is this. Over a period of the last 10 years, the resale price average growth have been about 26.9%. But on the other hand, the new launches over the same period of time, based on the average prices at the start and at the first quarter hitting at $2,011, the average price growth have been 59%. and that's a huge increment. And that's why the new launches are always in demand because of its capital appreciation. And when we look at ECs, it is always a Singaporean privilege, and ECs over the last 10 years have gone up by almost 68.2%. So I'm trying to highlight two things from these slides, Swing. One is the pattern and the growth over a period of 10 years, depending on what kind of property people enter right now. Yeah, that's why always EC stands out as a Singaporean privilege, but not everybody qualified. Between resale and new launches, one will have to decide. Resale does go up, keeping pace with inflation if it is the right property. But new launches do give an upper edge. But then we have to also look at the, in terms of the price gap. This is important because why the resale market is doing very well here is people are able to enter the resale market because of the price gap of 46%, which means for the same quantum, people are able to buy a bigger size unit. And people do need bigger size, especially from work from home. They want an additional room or space and so on. However, people have to be mindful based on the lease, decay, and all other things put together. Maybe we can discuss that in subsequent slides.
That's right. Actually, so, it is true that on a per square foot basis, the price gap is sizable. But actually, if you look on an absolute quantum basis, the pricing, they're all still rather palatable within the affordable sweet spot range for many buyers. I think if you look at new launches, 1.6+ million, private resale actually higher. And EC, it's just below 1.2 million. I think the per square foot price gap being fairly large is essentially a function of the pricing strategy, right? For new launches, I think people tend to buy smaller units, and developers are also mindful that quantum is a very big factor for investors and buyers for new launches. So they've kept the quantum low, but then on a per square foot basis, the prices will trend higher, and that's why it's a bit more sizable compared to this slide here that we see. Actually, resale is higher. Ismail, looking at the quantum, what's your take on this pricing sweet spot that would work for most of the buyers?
I think it's quite evident from here. When we look at private resale, I'm looking at more of homeowners because as a family, you need definitely a bigger space. In fact, the earlier slide did show that there is a price gap about 40% lower, and yet in terms of quantum, resale seems to be higher. Almost like doesn't make sense. But I think the logic here is this: the people who go for resale are homeowners who tend to buy bigger units. That's why the quantum is higher. And the sweet spot, in my honest opinion, for resale market here is anything between 1.5 to 1.8 is a lot of upgraders or a lot of people who desire to have the lifestyle are able to afford. On the other hand, new launches, as you rightly put, Wong Suing, even though the per square foot seems to be higher, but the average transacted prices are smaller because in the new launches, we see a lot of investors, and investors tend to pick up smaller units, the 1 bedroom, the 2 bedroom, looking at rental yield, and that's why the quantum is lower at play.
And I think maybe it's also worthy to point out that in Q1 we saw more central region launches, so that might also have some impact on the average PSF that we saw earlier. So going into the next slide, since we've been talking about ECs, Ismail, you said that it's a Singaporean privilege. So looking at this slide, we actually can see that the EC launches over the last few years, haven't really been as much as what we saw previously. If you look at the times before, in 2020, 2013, there are actually more units put on the market. Looking at EC pricing, Ismail, it's trending around 1,100 units, $1,100 per square foot. Do you think price resistance will set in at some point?
I think one of the key things, first thing, Swing, you have rightly pointed out here is this: when I draw this line downward here is this. When I look at the blue bars are the new units launched. Used to be the peak of 4,900 and tend to be 3,000 over new launch ECs in the past years of 2015, 13. But lately, ECs has become lesser in terms of numbers that is being, the government land sales being launched. So the choices are limited. But on the other hand, yes, there is a price resistance. In my view, EC prices that cross per square foot above $1,200 limits in terms of demand. One of the key factors here is this. People who are buying ECs, a couple of restrictions. Number one, have to be Singaporean, subjected to MOP. And most importantly, the credit assessment rules are different from private property. A private property, the total debt servicing ratio is based on 60%, while for ECs, a stringent rule of MSR of 30%. That's why the prices will not exceed at launch well above the $1,200 mark. Therefore, I think the 1,150 is a sweet spot, and even some of the recent launches have done more than 50% at the launch at this price.
And interestingly, this year, so far, the ECs that have been launched actually did very well, right? Park Central Residences, that was launched earlier this year in January. And recently we have Province Residence, that sold very well, more than 50%, as you pointed out as well. So, EC will still continue to sort of enjoy favor among Singaporeans.
Yeah, I think definitely. Beyond doubt, ECs is a Singaporean privilege, and I would say anyone who qualify based on the criteria should seriously look at it. And as we looked at it over the last 10 years, people who enter the EC market do make well above 65 to almost 70% capital appreciation.
So we talked about demand being resilient, looking at private home prices as well. Last year, we saw private home prices going up by about 2.2% for the whole of 2020. In Q1, we've seen a 3.3% growth based on the final numbers put out by URA. So, Ismail, looking at this, what's your projection on how home prices are going to trend this year?
Okay, I think this slide looks relatively busy with a lot of information, but I thought Xuyen, good job. You've been trying to put almost everything the last well above 20 years in one particular slide. But I'm just trying to tell the consumers out there, one of the key things people are asking, is this the right time to enter the market? Will the prices fall? And people do take reference to the earlier part, while they say that during the previous earlier days of the dot-com, or for that matter, even during the Asia financial crisis, prices did drop by minus 20%, minus 40%, or during the global financial crisis, prices dropped by minus 24%. Why aren't the property prices during this pandemic not dropping in double digit? And that's why people are hesitant. But people need to realize this. Because of all the cooling measures that were introduced, today in the real estate market, we don't have speculators. Because in the past, during the various crises, speculators who entered the market wanted to flip the property, and when there is a crisis and they are over-leveraged, they dump the property. Ever since 2013, that's why it's very, very evident swing. If I look at it, in fact, despite the cooling measures announced in 2018, only for 2 quarters, the prices went down by minus 0.7, and then it started to move upward, plus 3.4. And then last year, during the pandemic first quarter, people were a bit nervous, went down by minus 1, and thereafter, in the subsequent 4 quarters, still went up by 6.6%. So what it shows here is this. Today, the real estate market, we cannot compare to the past era to make decisions. That's why there are many other webinars are being lined up for you to have a better understanding. But this truly says the market today is very much more matured and in control in certain ways.
That's right. So we're looking at certainly less volatility, less of those boom and bust scenario, if you would, but more measured, orderly price movement, right?
Yeah, that's beyond doubt. That's definitely beyond doubt. So that's why today the real estate play is no more speculative. Anyone who enter the market will have to be mid and long term of 5 years and beyond. So obviously inflation, leveraging the mortgage interest rates being low, one would be able to realize as long as have the holding power.
So interestingly, I think, because prices have been going up over the last few quarters, right? There's been a lot of talk out there about, whether there would be new measures coming up later part of the year. I think before we go there, let's just do a quick throwback to 2018, right? I think in July 2018, we saw the government introduced new cooling measures. And if you look back at the price trend, right, before that, prices rose by about 9% between, Q2 2018 to Q2 2017. And this is not a magic number, but if we take reference from this, the price increase that we've seen in the last 4 quarters, actually at 6.6%, it's not as much. Prices haven't been going up as fast. What's your take, whether there are going to be more measures in the, months to come, noting that in Q1, we saw a 3.3% increase. That's fairly sizable.
Yes, I think we do not want to speculate on whether there will be a cooling measure, but my stand is always this. As an investor, we don't make decision whether there will be a cooling measures or not, because we always have to be mid and a long-term view. But based on your earlier slide, what Wang Xuing that you highlighted here is quite evident. The last cooling measures took place when there was a 9%. I think the authorities don't like a double-digit growth. And that is truly understandable because prices have to be sustainable. Our pay and our salaries are not increasing in tandem. So the government came up with the cooling measures to manage and cool the market. But what is looking at the next slide, which is right now, for the last 4 quarters, property prices have gone up by 6.6%. But my concern here is this swing is looking at the last 2 quarters, which when we look at the 4th quarter, which is, and as well as the 1st quarter of this year, the total price have gone up by 5.4%. So what is the likelihood of a cooling measure stepping in? Because if 2 quarters is 5.4, if in the subsequent 2 quarters, we still have 3 to 4%, it is definitely going to go to a double digit. Is there a concern? Probably. Are the authorities keeping a keen eye? Certainly. So my view here is this. There may be a cooling measures, but what form of cooling measures? One of the key things as far as cooling measures I'm thinking here is this, a little calibration in total debt servicing ratio, currently at 60%. And the authorities may well feel, and it is right in their opinion, and I support that, if the prices have a runaway, is to curtail the borrowing in order to be prudent in an outlook of an economy that is not so rosy.
And that would really address that issue of, a lot of liquidity in the market. We're not going to crystal ball on the cooling measures any further, but we're just going to move on to the next slide. I think earlier we mentioned dwindling stock. And I suppose, Ismail, looking at the, drop off in the unsold supply, it's fair to infer that prices are not going to plunge because, the supply has been very tight. Looking at this chart here in the 1st quarter of 2021, we're looking at 21,600 unsold units. This is sharply down from 36,800 units in the 1st quarter of 2019, right? So I suppose when the government introduced new measures back in 2018 July, the concern probably also had to do with the ample stock oncoming supply. But right now, it's probably a different story, Ismail.
Yeah, I think I totally agree with this. I think a lot of investors out there, home buyers, purchasers, need to understand the current demand and supply and the unsold stock. Exactly as been pointed out here, is in the last 2 years, from the 1st quarter of 2019 to this year, the number from 36 have come down to well below 22,000. And earlier part that Xuing and myself was highlighting to you, in a 10-year or a 20-year average, the demand has been more than 10,000. So with these numbers, that's why the market remain resilient. And whether is there a possibility of an en bloc coming in, as we witnessed in 2017 and 18, possibly, as long as the owners ask a reasonable price. Because the developers are still rather cautious in today's market based on construction costs, not being able to get the workers in and so on. They don't want to overcommit for an en bloc and they are in trouble down the road.
So, we're just going to break down this dwindling stock a little bit further by region. So interestingly, I think if you look at the average annual new sales between 2004 to 2020, the CCR average annual sales, we're looking at 2031. Similarly, in the same way that we calculate for RCR and OCR, the average annual new sales in RCR 3528 and then 5,600 plus in the OCR. So if we use these numbers and we look at the total unsold stock as at Q1 2020, actually the inventory run rate, it won't take very long to sell off the various unsold units in each segment. So in the CCR, if you take 7073 and you divide that by the 2021, you get 3.5 years. Looking at all the different segment, I think OCR seem to have a bit of an imbalance, in terms of having, not enough new stock, Ismail, 1.2 years run rate.
Yeah, I think that's one of the concerns that we all have, and why the resale market in the OCR has been doing well. And if people who are entering the market and hoping that the prices are likely to go down in a double digit, it's very unlikely, because especially when we look at the OCR, the balance stock of 6,805, and based on the average over a period of the umpteen years, it has been 5,674. We are only looking at a 1.2 years of run rate. And that's why the market have been resilient in some of these sectors. Only maybe at the cost central region, we have a little bit more excess supply. It can run for about 3.5 years. And that's something, the right number for almost every sector. 3 years supply is unexpected.
So in a sense, developers are not in any, urgent, dire need to lower prices to move units?
Almost certainly, yes. Because most of the developers have sold well above the 50, 60, 70%, the hurdle rate where they are concerned about to the financing and things like that. And therefore, developers are actually pricing it higher as more units are being sold in order to average out their profit bottom line.
And you talked about, developers enjoying healthy sales. And actually, that's also reflected in the appetite for residential sites. I think we pulled out some recent GLS tender outcome and prices. So these are the sites that have been successfully awarded. Just look at the top two in Northumberland Road, that's in Little India, and Tanah Kirkhill Link. 10 bidders and 15 bidders. And the pricing in terms of land rate for per square foot per plot ratio, fairly firm as well is now.
Yeah, I think this is another telltale sign of the future pricing. As we exactly said, with the dwindling stock, developers' land bank is running out. And as exactly we witnessed in the last two, just November and May this year, the government land sales, we have developers 10 to 15 people out trying to outbid each other. And we are going at per square foot per plot ratio near Tekka Farrer MRTS, 1,129, even at Tanah Merah at $930. These are going to be the firm land cost prices, which means their launch prices are going to be well above the $1,500, $2,000 mark in the near future, such as holding the price from further dropping.
Looking at this slide, certainly the developers are looking to replenish their land inventory and, are willing to sort of pay for choice sites, right? So looking at the collective sale market, Ismail, do you expect developers to really, go into collective sale in earnest at this point? And what sort of, sites you think will do well? Obviously, OCR, they should get a look in, right?
Yeah, I mean, we have spoken to many developers. Their appetite, they dare not, or many of them shy away from developments that goes into 1B or closer to 1 billion or 1.5 billion. These are huge mega sizes. There is a strong demand for en bloc sites that are priced anything between 200 million to 5 to 600 million. Developers are ready to come in, knowing there are some risk factor with the current constraint of workforce and cost of materials, but really the developers are running dry in terms of the land bank. So the important thing here is as long as the en blocs are priced right in terms of per square foot per plot ratio, there is a strong demand.
And we keep talking about demand, and actually a lot of it stems from the HDB's upgraded segment. If you look at this this chart here, there's just a bumper crop of HDB flats due to exit the 5-year minimum occupation period, or MOP, this year and also next year. You're looking at 25,000 plus this year, 31,000 in 2022, which actually mean that these units could potentially be put on the market, on the resale market, to be resold. increasing potential resale supply in the HDB resale segment, and which could help to sort of stimulate demand. And obviously, people who've sold their HDB flats could look to upgrade. So then there's that recycling of capital into the private residential market. Ismail, are we seeing a lot of HDB upgraders coming into the market right now? What are some of the considerations?
I think beyond doubt, Xuing, I think it has been quite evident in terms of the OCR projects have been doing very well. The resale market has been doing very well. And the fact that HDB property prices have been on the upward trend in terms of price increment, it allows many of these people whose the BTO flats are coming to MOP. Last year was 24,000 plus, this year 25, next year 30 over thousands. And naturally, in terms of lifestyle, and some of these BTO owners are able to make a capital appreciation, 100, 200, 300, or 400, depending on where is the location and the size of unit. And many of them, not all, or at least some of them, desire to have a better lifestyle and move to some private properties. And that's why the demand for private properties are even uplifted overall.
You talked about HDB resale prices. So I think let's pull up the next slide. So in the first quarter, HDB resale prices actually rose by 3%. This is after rising by about 5% for the whole of 2020. And, I think the HDB resale, prices, they have been fairly muted for a number of years right now. And if you look at Q1 2021, we're just about 4.8% below the peak that we saw in the second quarter of 2013. Ismail, this uptrend in prices certainly a cheer for HDB owners. Do you think a lot of people would be considering, taking this opportunity to sell at this point?
I think, Xuing, honestly, I know not everybody will agree, especially if they are going to buy a resale flat, because the prices have to be on the upward trend. Last year was 5% and the first quarter is 3%. But I must say, not forgetting for the prior to 6 to 7 years, it has been on the downward trend. And there are million HDB owners who are not able to realize any form of a capital appreciation because of the accrued interest on CPF and all other things put together. So I think it's a good news that the HDB property prices are moving upward, but I only hope it is not a double-digit growth annually, because that is not sustainable. So obviously, with the government increasing the demand in terms of grant, okay, not the demand, the government have increased the grant for newly married couple of first-time buyers. And this has also created a stronger demand for resale, because the BTO flats are today delayed to 4, 5, and more years for it to complete it. And that's why there's a push factor for the prices to go upward because of strong demand.
Okay, well, we're just going to move right along the next few slides so that we have some time for Q&A. Looking at resale demand, we've actually seen fairly strong, resale volume in the first 4 months of the year, touching nearly 10,000 units. Ismail, we'll come back to you later for the outlook. I'm just mindful of time, keeping some time for Q&A. And also looking at $1 million resale deals for HDB, 74 in the first 4 months. I think we're looking quite likely to exceed the record 82 units resold the whole of last year. And, in this table here, just the top 5 in the first 4 months, top 3 in Bishan. Moving to the next slide, I think we're looking at, some of the key drivers again. Just a quick recap. We've talked about how demand has been fairly healthy. We looked at how cooling measures have actually sort of kept prices in a healthy and stable state. We looked at ample liquidity. We saw how declining unsold stock would likely impact prices, and also the improving economic outlook and sentiment. I think in Q1 2021, so based on advanced estimates, Singapore's economy grew by 0.2%. I think the forecast is still for Singapore's GDP to grow by about 4 to 6% this year. So it remains to be seen how this phase 2 heightened alert will impact or the recovery that we've seen so far. Ismail, looking at the pandemic measures, looking at the cooling or potential cooling measures, if any, What's your sense, whether this will impact resale volume or new sale volume going forward?
I think to an extent, marginally swing. Those people who are not very savvy in technology-wise, they may postpone the decision. And second thing, some of them also postpone the decision because of safety conscious, and that's very, very valid. But we are not expecting the numbers to tumble by 50% compared to the previous quarter, the previous month, because we still see people are more comfortable with virtual tours and viewings to narrow down and only going to houses that they think suits their needs and the budget. So therefore, I think the real estate market is still going to be resilient. The numbers may come slightly down in the month of May and June, but as we experienced even last year after phase 2, there was suddenly a huge demand that just pushed in terms of volume and as well as prices. These are all something it is likely to happen moving forward.
Well, we've talked a lot about, what the market has been, just, feeling the pulse of the market. If you look at this slide here, it actually lays out some of the projections that we have. And if you look at the highlighted, the figures highlighted in yellow, actually it's all fairly optimistic. Ismail, take us through this outlook.
Yeah, I think thanks, Shueng. I think we're almost coming towards the end of it. I really must say how I wish we had 1.5 hours and go in depth in many of the things, but it is just not possible. But we have done in a very broad macro perspective, and these are the 3 segments that we really talked about: the HDB market, the private resale, and as well as the private new launches. And I'm pretty confident that we are going to have a breakthrough with the record numbers, well surpassing last year's numbers. And as far as the HDB resale, we are likely to go well above 26. It can be 27,000. Private resale is going to go back to the heydays of the 2013 to 14 to 14,000. And private new launches, I will not be surprised, 10 to 11,000. So there is definitely a strong demand, and the market is moving despite the pandemic. And one of the key things here is this, Swing. As much as we want to do here is this for all the listeners, just don't stop after this, the initial event. Calvin Fong is conducting another seminar in the next hall, giving you a better understanding. Is this the right time to upgrade? I'm back this afternoon to give a little bit more depth of who's buying and what are they buying and so on. So next 2 weeks, huge amount of webinars and seminars. I'm not going to take over the host Steve's job, but I'm just trying to say here is the market is really exciting moving forward.
I think just pulling up some questions for us. I think the first one, Ismail, you mentioned that the economies of scale for, mega development. So what's your take on smaller size boutique developments as a form of investment? So we're looking at, whether it's, what's your advice for people looking to invest in smaller developments, Ismail?
I think one need to understand there are people who don't like huge mega development because they don't like the crowded of the common facilities. They want privacy and many other things. But for example, you look at it like Telok Kurau area, and many of them are smaller development of anything 50 to 100 or even 40 units. So you will have to be very certain it suits your needs and your budget. One of the, sometimes the challenges are when you want to sell in the resale in the future, many of them would not have heard about smaller development names as opposed to developments that are bigger. So therefore, obviously you have got a bigger audience who are prepared to look at your property. But again, on the flip side, the mega developments also at any time, there are more than 1 or 10 people selling. So you will have to compete with the other sellers in terms of the pricing. There's no right or wrong. But one of the key things here is this: does it suit your lifestyle? Smaller developments tend to have less amenities and facilities. But if the price is right and you like the locations and the convenience, why not?
Earlier, I think we didn't have a chance to talk through some of these points, in terms of what are some of the considerations, going into resale properties, Ismail. Certainly lease decay is one. What are some of the key factors you think buyers looking to, evaluating between new launch and resale need to think about?
I think it's a very good question. Because of time, we were not able to highlight. Probably in the afternoon, I may spend a bit more time on this thing. But one of the key concern here is this: as the lease decay, especially if you buy a resale flat, that has balance lease of less than 70 years, there will be some concern. Because as you stay there for the next 10 years and the lease goes below the 60 years mark, there's some restrictions in the usage of CPF funds by the subsequent buyers. And eventually, if an en bloc do not take place and the conditions of that development is also not as up to date as of some of the newer development, it may lose its flavor in terms of price appreciation. So one have to be careful. It's perfectly okay to buy a resale. I would recommend for people to buy resale properties anything less than 15 years old, and you enjoy the stay for the next 10 years, and you try to exceed, leaving behind 70 to 75 years for the next buyer so that you can go out with reasonably good value appreciation.
There's actually an interesting question coming in, whether there's any chance for a further boost in the PSF prices once the pandemic measures, have been loosened. So what's your take? Again, crystal balling is one.
Yeah, but definitely it's very hard to really speculate. But having said that, one of the key things, as you rightly pointed out, 79% of cost central regions buyers have been Singaporeans. Why so? It is in the absence of foreigners being able to come to Singapore. And we know foreigners' numbers of percentage have dwindled in the last 2 years, purchases of the Singapore real estate. But obviously when the restrictions are maybe lifted, we will have more competition, more people, and having known the fact that Singapore handled the COVID so much better, I think Singapore properties is going to be in a global interest.
We actually haven't talked about this as well earlier, so we've talked about pricing. Obviously location is a big factor as well. What's your take on, transformation plans? How's that going to impact future potential capital appreciation, opportunities?
Yeah, I don't want to sound like so abstract. I always used to say all capital appreciation is a byproduct of rental yield. Let me repeat, all capital appreciation is a byproduct of rental yield. If anybody buy a development at, let's say, 1.5 million and the rent now is 3,000, in 10 years down the road, if the rent still remain at 3,000, how to sell at 2 million or 2.5 million? So the rental must go up. So rents will only go up if the transformation of the area is uplifted with the increase in workforce or other kind of lifestyle. So it is important that transformation being considered in any purchase so that there is a future capital appreciation potential.
We actually have a lot of questions. I think for the sake of time, we probably only can take two more. I think one of the questions had to do with resale HDB prices. So I think this Keith wanted to know whether we expect HDB resale prices to escalate, and also what is your projected HDB resale demand?
Yeah, I
think we talked about the demand earlier.
Yeah,
about 26,000 units for this year.
Yeah, Swing, I definitely must say the authorities have a very difficult time. I'll tell you why. In the past, when the HDB prices were going in double-digit growth, and that was something not preferred by most young Singaporeans, because at entry level, it became not so affordable. So what the government did in the earlier years when the property HDB prices came down, they increased the BTO every year by 25,000, 25,000, 25,000. But right now, HDB is in a difficult situation. Increasing BTO will not solve the problem because the construction delay is still there because of the current pandemic and the shortage of workforce. So which means to say, government have got limited choice of increasing BTO, and yet people need a roof over their head. And that's why the HDB resale market is going to continue to be strong. Yep. And therefore, I expect the HDB prices to go double digit, at least for this year, as a recovery for all the negative losses in the last couple of years. But to me, sustainable, it should be anything between 5 to 8% in a year. Actually, it's considered high. Ideally, should be 5% annually. It's more or less sustainable.
I think there's a question from Jason as well. Earlier, we did talk about how, investors, they tend to look at, many investors tend to look at smaller units and new launches because, they're very quantum sensitive, right? So Jason wants to know whether there would be, future demand for one bedders. Are they actually sustainable investment properties, so to speak?
I think, Jason, I really wish to share this completely. Maybe should attend some of the other webinars conducted by either Calvin Fong, myself, and few other speakers and so on. You have a choice to choose. But we really want to explain this. Yes, most important here is this location and the many factors. You see, one of the key things here is this one bedroom, who will rent out? It is not going to be a family. It is someone who's working for an MNCs on a single, and therefore it is definitely important location where one would want to buy. Overall, I think there is a demand, and especially today, a lot of people are work from home. Even a one bedroom and a single would prefer to work from home, and this is going to be the new trend. Not to worry about, but your selection criteria will have to be really well planned and thought through.
There's also a question on CCR prices, whether you're expecting, what's your expectation for CCR projects? I mean, given that obviously we will see more launches in this segment as well, given the reduction in expat population, for example. So they want to know how this will impact CCR prices.
I think broadly speaking, the cost central region prices are well above the 2,005 to 3,000. Let's not talk about the super luxury properties that goes up to 4,000 and above. By average, we are looking at cost central region well above 2,500 to 3,000. But what is happening right now here is some of the recent launches in the fringe of the CCR, even though they're CCR, have been coming at 2003, 2004, 2005, the lower of the mid twos. And that have been very attractive for Singaporeans. Overall, I think the cost central regions is not expected in the long term to go below 2,500. It will be well above 2,500, and the sweet spot will be somewhere or 2,750 to 2,008 will be the prices for the cost central region.
I think we've ran out of time, Ismail.
Yeah, I wish. I think to all the listeners, please follow us through all these webinars of the SPS. I'll be more than happy to come and just address. And if it's really not during these webinars, some other opportunities, hopefully to stay connected. Thank you so much as well.
Thank you.
So I want to say thank you to Ismail and Siu Ying for sharing that session with us. I'm very insightful. I mean, we all have our opinions on how the property market should have been this year, especially with the pandemic changing things. But some surprising and interesting nuggets of information there. So if you are into the property market, I mean, we could have these guys talking all day. They live and breathe property. So I know Ismail could go on forever if we gave him the chance to. But you will have a chance to listen to many other sessions. There are many other webinars happening today. So go to the website and you can sign up for those as well. But now it is time for those of you who took part in a lucky draw to find out if you won yourself a prize. Let's pull up a magic wheel. And let me try that again. Let me pull up my magic wheel. Whoo! Oh, it's not so magical. Okay, there we go, there we go. And now, wow, there are so many names in there that I just see nothing. It's just amazing. Okay, let's give it a spin. Ready? 1, 2, 3. Okay. And it will reveal our first winner. Yo Zihan. Yo Zihan, congratulations. You are the first of our 2 winners to win $100. We are going to spin the wheel again one more time for our second winner. It is spinning and it will stop here. Let's see who our next winner is. Rosalind Tan. Rosalind Tan, you are our second winner. So congratulations to both of you. The folks from SPS will be in touch with you to tell you how you can pick up your prize. Again, these lucky draws are happening at every session, so make sure you sign up at the beginning. There is another session currently running now about how you can, what you want to do if you want to upgrade from HDB to private property. Otherwise, do stay with us. There are many more sessions coming up. We'll be back here in about 20 minutes for our next session. I'll see you then.